Now, in this lower inflation environment, this has been a good environment for bonds.
That's right.
Right? And so, while we're talking about inflation, I know a lot of clients have asked about bonds. Maybe they're a little less volatile than the stocks. Can you share your thoughts while we're on the subject of inflation? Just share your thoughts on bonds.
Yeah, basically, you have a real problem nowadays because some people are worried about deflation, and there's evidence that you could be concerned about that. People are worried about inflation. There's a lot more evidence long term, if the government doesn't handle it right, that you have it. So you're in a position, so what do? It isn't, oh, we're going to have inflation. You know what to do. You buy all the inflation hedges. Oh, you're going to have deflation. You go to cash and bonds. But we don't know which way it's going to go. And so most people are really at a loss, like, what do I do? If I have inflation, I would act one way. If I have deflation, I act another way. But what if the probabilities are either way? So I've done a lot of thinking about that. Now, a lot of people are rushing into bonds. And let me say one thing. Bonds have a place in anybody's portfolio that's concerned about the short term, like if you're worried about sending your kids to college in the next 3 or 4 years and you want to keep that money and not have to worry about the volatility of the market, you put it in cash or bonds. People have sinking funds for different projects. Companies have projects like pension obligations they got to meet, so they got to keep some of the money in bonds. So there certainly is a place for bonds in the portfolio. But the idea is that the bond market has been in a bull market since 1981. So it's been in a bull market for 30 years. The inflation has gotten about as low as it's going to get, maybe a little lower, but not much. The bonds have gotten about as high as they get. And over the long run, when you have a 30-year bull market, it takes almost 1/3 of the time to erase the excesses that have built up. The bond market is pretty richly priced, especially if we're going to have a little more inflation. So there is a risk in long-term bonds. Now, having said that, we just made a trade in a long-term bond because when we get a value, and we believe at 4.75 with a very low rate of inflation, a long bond is a good bet for the next few years. But I wouldn't keep that bond over the long run because over the long run, I don't think it would be a good idea.
That was more of a 3 to 5 year type of loan.
Yes, and probably even shorter. So the idea is if you're going to be in bonds, it still has to be managed. If you're worried about deflation, you want to go out a little longer. If you're worried about if you're worried about inflation, then you want to keep your maturity short so that you can keep rolling it over. Now, we've done a very good job managing bonds. We've had a very good performance over the last 30 years. And in the last few years, as you know, we created a fund. Tom Sider, which is our bond manager, he's just done a spectacular job of managing it. And as you know, we've got a 5-star rating on it. It's one of the top performing bond funds in the country. But what Tom is doing is the same thing we do with stocks. He right now is in 36% cash. And the reason is because the bonds are overpriced and he's looking for an opportunity. So if you're going to manage money in bonds, you still have to either manage it where you sell them when they're overvalued because you're going to be in a long-term bear market, and you buy them when they're cheap. Now, most bond funds just keep themselves fully invested, so if you're going down in the long run, that might not serve your purpose. If you're going to choose a bond manager, you should choose a manager who has the flexibility of going to cash, selling out, and there's many bond funds and managers that do that. Our position is, yes, if you want bonds and you feel that they are part of your portfolio for many different reasons, you buy them, and we would buy them, but we would manage it, and we would go to cash in the bond section of the portfolio, just like we go to cash in our stock portfolios.